and our esteemed participants. And I welcome you all to the Lagos Chamber of Commerce and Industry Economic and Business Outlook Seminar for the year 2021. My name is Matthew Ojo, and I'm happy to take us through the programs that we have for today. We appreciate your continuous support. Each time we seek your presence, you're always there for us. And we're happy to run this year through with our experts, teaching us how to navigate this year 2021 economically and in terms of business. The experts will be looking at reviewing the previous year, last year's performance in terms of the economy and business, and also be able to help us have a better understanding of how to take important business decisions based on the knowledge that we're going to gain here today. So you are once again very welcome. Before I proceed, let me take us through a run of the programs or the events for today. Right after this, we shall be taking an opening address from the president of the Lagos Chamber of Commerce and Industry, Mrs. Toki Mabugje. And thereafter, we will move straight on to take our first presentation, and that will be delivered by Dr. Biodun Adedipe. And after his presentation, we'll move over to the second presentation to be delivered by Mr. Bimbola Lashure, FCA. And when he's done, we'll go to the third presentation for the day, and that will be done by Mr. Mohammed Adama. When we are done with the three presentations, then we move over straight to the question and answer session. And after that, we have a closing remarks, and then we'll close for the day. So we are straight on to business today. We don't want to waste your time. And for those of us who might have questions, please take advantage of the question and answer box there on your screen to make your questions available to us. Thank you very much. So to help us start the program right on, I would like to welcome the President of the Lagos Chamber of Commerce and Industry, Mrs. Toki Mabugje, to deliver the opening address. You have the floor, ma'am.
Good afternoon, everyone. Thank you, Dr. Ojo. Our distinguished facilitators, Dr. Biodun Adedipe, Chief Consultant, B. Adedipe Associates, Mr. Mohammed Adama, Partner KPMG Nigeria, Prince Abimbola Olashere FCA, the Honorable Treasurer of the LCCI, Dr. Ayo Teriba, CEO, Economic Associates, and Chairman of the LCCI Economic and Statistics Committee, officers and council members here present, Ambassador Ayo Ulukoni, Director General, Nigerian Association of Chambers of Commerce, Industry, Mines and Agriculture, NASIMA, Dr. Muda Yusuf, Director General of the LCCI, captains of industry here present, members of the diplomatic community, distinguished ladies and gentlemen. It is my pleasure to welcome everyone to the 2021 edition of the Lagos Chamber of Commerce and Industry Economic and Business Outlook Seminar with the theme Economic Outlook and Business Sustainability Strategies. This is the first time the seminar will be held virtually, given the limitations on physical gatherings occasioned by the coronavirus pandemic. As the theme suggests, the essence of this gathering is to promote conversations and share perspectives on the outlook for the Nigerian economy with respect to the business community and the financial market in year 2021. Additionally, this seminar aims to enlighten members of the business community on key economic trends that will shape the new year, which is crucial for business planning and investment strategies. Participants would also be exposed to the fundamental principles of business sustainability at this session. Distinguished ladies and gentlemen, as you all know, the year 2020 was historic and challenging for the global and domestic economy. All through year 2020, Countries across the globe, including Nigeria, grappled with health and economic impact of the coronavirus pandemic. Last year was characterized by imposition of lockdowns, curfews, and other restriction measures, substantial volatility in commodity prices, subdued external demand, social tensions, NSAS protests, heightened insecurity, foreign exchange squeeze, and subdued business activities and investment uncertainties. However, the Nigerian economy is expected to exit recession in the second quarter of the year 2021. Output growth is expected to remain subdued within the region of 1%. Overall, the pace of economic recovery in 2021 depends on key factors, including A, the effective management of the pandemic locally and globally, B, widespread vaccinations, C, direction of the oil market, and D, the quality of government policies. Distinguished ladies and gentlemen, this period is a major test of our resilience and a challenge to our entrepreneurial and innovative capacities. Several businesses across various sectors were forced to readjust their operating models to fit with the current realities. Technology adoption in business operations gained traction in the previous year as businesses prioritized innovation, revenue optimization, and cost reduction plans. The pandemic will be with us for a while, and it has therefore become imperative for business operators to devise strategies to keep their businesses running amidst this disruption. All these present some key lessons for economic agents, including investors, business owners, entrepreneurs, and policymakers. So, one, businesses must maintain a flexible operational structure by embracing technology to adapt to changing market dynamics. This will facilitate a smooth transition when implementing remote working structures. Secondly, corporate entities must constantly review their operating models to identify activities that can be discontinued during this COVID-19 pandemic in order to reduce their operating costs and support margins. And three, the need for policymakers to expeditiously develop a framework that would ensure that the country has a well-diversified revenue base, as proceeds from oil products have become very unreliable. This is imperative for macroeconomic stability and sustainable economic growth. So at this juncture, let me appreciate our resource persons for honoring our invitation despite their very busy schedules. I appreciate all of you participants for being here and for your interest and participation in this program. Welcome to the seminar and thank you for your attention.
Thank you very much, Madam President, for that wonderful opening speech. And just as you mentioned, we want to recognize the presence of captains of industry here with us, as well as members of the diplomatic corps that are on this platform with us. I also want to recognize the presence of the Deputy President of the Lagos Chamber of Commerce and Industry, Asiwaju Dr. Michael Olawale Cole. You are very much welcome, sir. So right away, we move on to our first presentation, which will be delivered by Dr. Biodun Adedipe. He's going to be looking at the macroeconomic outlook for the year 2021. Before then, let me just inform us that Dr. Adedipe is the founder and chief consultant of AB Adedipe Associates Limited, BAA Consult. With about 4 decades of postgraduate work and professional experience that cuts across university teaching, investment banking, project financing, management, and financial consulting, as well as leadership in business and not-for-profit organizations. Dr. Adedipe had an illustrious career that has taken him through the University of Lagos, Enterprise Consulting Group, the World Bank, African Region, International Merchant Bank PLC, and First City Monument Bank PLC. He has served in various capacities in government, including member of the Presidential Committee of Experts on the Redenomination of Naira, that was in November 2008, and was a member of the Federal Government Committee of Experts on Expenditure Review between October 2010 to March 2011. And he was also Senior Special Assistant to the President on Financial Sector Development. That's in the Office of the Chief Economic Advisor, and that was in 2011. Distinguished guests and our esteemed participants, I have the pleasure of welcoming on stage right away Dr. Biodun Adedipe. Sir, you have the floor.
Thank you so very much, Dr. Ojo. And I want to start by expressing my deep appreciation to the President, Mrs. Toki Mabogunje, and the Council members of Lagos Chamber of Commerce and Industry. It's my pleasure, and indeed, again, I count it a privilege to be invited to share my views and opinions about the Nigerian macroeconomy and my views about the outlook for 2021. I prepared a couple of slides. I will share them quickly and speak to them within the time allocated to me. So I will share my screen right now and then talk through the key slides. These slides, of course, will be available to all the attendees because I will share them with Rotimi immediately I finish my presentation. So now the caption I gave it is Coronanomics, the world and Nigeria in 2021, a review and also an outlook. Now, what I call a starter here is to pick on some interesting pointers that some interesting, let me put it also that way, stakeholders in the global economy have said in transiting from 2020 to 2021. And the president has done a fantastic x-ray of what 2020 was like and what we should possibly train our minds to process in 2021. Now, the London Economist has done quite a lot of work, but came up with this summary, which I find very interesting. And it says, inter alia, globalization has been truncated, which means the way we knew globalization before COVID-19 has changed. Secondly, the digital revolution has been radically accelerated, which is to me simply that what we're envisaging will happen in the new decade we are in actually began to happen in 2020 with respect to digital transformation, assimilation, and indeed, as President said earlier on, a remodeling of the way we do businesses and relate with our customers. Then thirdly, the geopolitical rivalry between America and China intensified in 2020. Of course, we have a pointer already from the Biden administration that this is unlikely to change in terms of the principle, but the approach, in any case, might be different. Equally, in 2020, we saw the pandemic worsening one of today's great scourges, which is inequality. Again, the data available and discussions show clearly that where we were at the beginning of 2020 is not where we are today in terms of the risks to sustainability, not only of business, but even of the universe where we are, as so to say. There's also the worry about climate change. Now, what does this mean to us in my own interpretation? What it means there simply is that if 2 or 3 of these 5 key issues do not feature in your business strategy for 2021, then something will be terribly wrong with your strategy thinking. So now that is on the one side. Now I looked also at the view of McKinsey relating to the pandemic and the global economy. And then, of course, what he pointed out as COVID-19 created a massive humanitarian challenge. And let me point something out here. When the COVID-19 became a pandemic, declared to be a pandemic, March 2020, I had a particular slide to interpret how this would likely play out. And interestingly, nearly every country around the world has experienced the full cycle of 4 crises that I identified then will likely be the aftermath of COVID-19. Number one is COVID-19 itself is a health crisis, okay? That was the first of it, health crisis, meaning something comes up that you just have no clue as to how to deal with it, and of course, how to relate with the unseen enemy, so to say. But that if governments did not respond appropriately to the health crisis, it will become an economic crisis. And we've seen a lot of that all around the world. Lockdown, as the president said earlier on, and then reopening, even reopening partially, and so on and so forth. There are still debates, and in fact, what I will call street fights with respect to lockdown, especially what we have seen in the last couple of days in Lebanon, in Netherlands, and so on and so forth. Then the third issue is if you don't handle the economic crisis very well, it will become a humanitarian crisis. And there's a pattern to that. Once people exhaust what they have on hand, which is available at home, then they resort to their savings if they have access to it. Once they finish their savings, they resort to selling assets. And by the moment they find that there is no asset again to sell to sustain life, then it becomes a real challenge that somebody needs to make an arrangement to get sustenance to those you require to be under lockdown. If you don't manage that humanitarian crisis effectively, it will become a security crisis. That is the full-blown cycle that many countries have gone through so far. Now, what this means in terms of inferences, when everything is no longer what it used to be, it is time to rethink everything, just like the president said earlier on. So what are those things we describe here as the pre-existing vulnerabilities when it comes to COVID-19? There are 6 of them identified here. First is for resource-dependent countries. I gave 2 examples here, Nigeria and Bangladesh. Nigeria on hydrocarbons, Bangladesh on export of garments to Europe and the Americas. Now, for those 2 countries, as example here, what COVID-19 has shown clearly is that the vulnerability of being entrenched in the global supply chains and also having to depend on the rest of the world in terms of demand and supply nexus has been exposed as indeed a major challenge. Also, many countries, because of COVID-19, have actually become highly indebted. There were a few of them we were talking about before COVID-19, but with the advent of COVID-19, countries and governments all around the world had to borrow and find money from anywhere they could find it in order to deal with the health crisis and also manage the economic crisis in order to avoid humanitarian and what I said earlier on, security crisis. Of course, for countries like Nigeria, with large informal sectors accounting for about 52% of our GDP, and of course, that also tagging along with low productivity, that remained a major challenge. Micro, small, medium scale enterprises, again, very dominant. And that, of course, is obvious if you look at the data of membership of LCCI, for example, or even check the data put out by MBS with respect to the manufacturing sector in Nigeria. If you do head count, that data shows clearly that about 91% of manufacturing entities in Nigeria by head count is actually SMEs. Then large populations. Nigeria's population estimated at about 208 million people end of 2020. But most of them have also in the last 5 years, and it's important to note, have migrated from the rural areas to the urban areas. 51% now in the urban areas in Nigeria, which is a switch from about 47% that we had in 2016. Now, high poverty incidence, of course, not as bad as people make us posture, at least until MBS came out with the poverty study that showed clearly that the percentage below the poverty line is not as high as 80%. That was the narrative created by most foreign analysts that have no idea of the existence of what we call the social networks, which is the safety net for the low-income people in Nigeria. Now, how do all of this come together? I decided to show this slide in particular because what we call the misery index is a measure of the extent to which people are miserable in any particular economy or designated geographical region. So now, for Nigeria, of course, there are 4 basic statistics we use to construct this index. First is the lending rate, then the second is inflation rate, then unemployment rate, and of course, the GDP growth rate. Three of them carry negative signs, and that is lending, inflation, unemployment. They are negative in nature, which is simply to say that the higher the lending rate, the more expensive credit is. And as more and more people become dependent, and also corporates become dependent on credit, that means the cost of doing business and also the cost of living will be on the ascendancy. Same thing goes with inflation, which of course is one of the measures of livelihood in terms of the quality of life. So now, when you take all this together, what is expected is that the GDP growth rate of your domestic economy should be able to set against this and therefore minimize the adverse effect of an uptick in these three rates. So it then means your economy must grow at a rate faster than the addition of these three rates in order for you to improve the quality of life as measured by an economist. So we can see the chart there, how the mystery index has been behaving in Nigeria, at least in the last 10 years, so to say. Now, what is the structure of our national economy? Based on the latest available data on our GDP, which was for September 2020 for the National Bureau of Statistics, this is the picture of the Nigerian economy. Agriculture accounting for 30.4% of our GDP. And of course, we have that followed by trade. At times we call it simply distribution or exchange, 13.9%, followed by ICT at 13.5%, understandably so. In a world getting more digitized, where now businesses move from having server physically in their offices to migrating now to server in the cloud. And of course, migrating a lot of the activities to the cloud as well. I will make some remark on that later. Then we have also mining and quarry, that is where oil belongs. We have manufacturing, both of them accounting for about 8.9% of our GDP. And of course, real estate at 5.6%. These six sectors in the last 10 years have accounted for between 77% and 82% contribution to our GDP. So that's a pointer to where the bulk of value is being created within our economy. Now, I will skip this slide because it just goes further to illustrate, what I just said. But this one is important because this is where we begin to look at what to expect in 2021. Now, the projection done by the National Bureau of Statistics, that's Nigeria, is that our economy will dampen by 4.2% in 2020. Of course, until the data is put out, we don't know how that will shape out. But MBS, as at the time they put out these projections, were expecting our economy to grow by 3% in 2021. But of course, I will add a caveat to that, because anytime you have a forecast of what will happen to an economy is based on data available as at that point in time. Just as you see with IMF, for example, the last projection, the October 2020 outlook by IMF put Nigeria's growth rate for 2021 at about 2.6%. But now the latest one that came out just this week, about 2 days ago, put it at 1.5% for 2021, while the World Bank expects Nigeria's economy to grow by 1.1% in 2021. Now, those are the expectations, but I'll bring something on here that oftentimes people don't see when we interpret data about our economy. Yes, the economy dampened second quarter of 2020. It dampened, but at a slower rate in the third quarter of 2020, which, if you look at this chart, shows that there is already an upturn. The economy has actually turned up, going towards recovery as at the third quarter of 2020. Now, there is an interesting thing here. If you look at the GDP of Nigeria, current basic price, first quarter 2020, it was 35.65 trillion naira. Second quarter, dampened to 34.02 trillion naira. Third quarter, it climbed to 39.09 trillion naira. Meaning, if you aggregate our current basic price GDP for the first 3 quarters of 2020, you have a figure of 108.76 trillion naira. Compare that with what we had in 2019. That gives you 75.4%, which, of course, when you look at this and the trajectory, it gives you the confidence that there's a likelihood that the Nigerian economy in the first quarter of 2021 will likely exit recession. Now, equally, if you look at one major factor in all this, and that is our assumptions around crude oil production, export, and of course, the price. Most of the projections in terms of price of crude oil for 2021 point towards anything between $58 and $62 per barrel. But as at 10:22 a.m. today, the price of Nigeria's burning light was $55.38 per barrel as at this morning, 10:22 a.m. Now, all of these are pointers to what to expect in 2021. I won't spend more time on this. I normally cite this as a warning to show that the nexus between imports and exports has actually switched, which again is a reflection of where we were 5 years ago in 2016 when we experienced recession. We were now importing, and we still do that right now. We import more than we export. And that also explains why government has been worried and came up with a new policy with respect to how to boost exports. So now, manufacturing was expanding steadily up until December 2020. And of course, this came from data from the Central Bank of Nigeria, the monthly, what we call a PMI, that is Purchasing Managers Index. Now, if you plot that on the chart, this is what we get. And that shows clearly that up until December, or let me say November 2020, we saw a pointer that manufacturing in Nigeria was on expansion trajectory. But the PMI for December dropped below 50. Any figure, any index below 50 means manufacturing is shrinking. But if it's above 50, that means expansion. So that gives us an idea now in terms of what the president said earlier on in her opening remarks about the importance of government policy with respect to encouraging domestic manufacturing. This is something I believe will be of interest to everybody here, because every now and then everybody talks about the exchange value of the naira and where that may likely go. The external reserves of Nigeria in the last up to, let's say, 3 months, let me say, have been steady and around 35 billion US dollars. When I checked it as at this morning, and that is latest figure available on the website of the Central Bank of Nigeria, which was on 15th of January 2021, it showed $36.35 billion. Now, if you put that against our average monthly import bill, that translates into 9.12 months of import bills cover. Ordinarily, if we stay within the context of the management of the exchange value of any national currency, that should give some bit of comfort. But it goes along beyond that, because you are looking also, as I said earlier on, the nexus between your exports and your imports. Now, the best window to look at in terms of what will likely happen to the exchange value of the naira planning forward for businesses is if you go to the website of FMDQ, you will see there the OTC futures rates. And of course, that platform was created by the Central Bank and FMDQ. So I went there this morning as at 10:32 a.m. The indicated exchange value of the naira for end of each year from this year to 2025 is what you see on this particular slide. So if I'm planning for my business, therefore, and looking at the exchange value of the naira to adopt for planning, then I will look at this for December 2021 at 434.69 naira to a dollar, and continue like that for the next 5 years. So which means anytime you can go there, you don't need to come to Dr. Adedipe to get this, all right? Now, in terms of capital importation, of course, we see clearly here, a report was put out in the last 1 week about capital flows around the world in 2020 as impacted by COVID-19. Of course, the figure shrank significantly. But again, if you look at countries that benefited from that, you will see clearly that African countries were not on the right side of benefit with respect to that, and Nigeria is part of that. Now, I won't say anything about it because this is Prince Olashuri's terrain, and I'm sure he's going to talk to us about this, the stock market. Yes, the Nigerian boss ranked the best global growth rate in year 2020 for obvious reasons. The interplay between monetary and, of course, the capital market simply show clearly that there was a shift away from fixed income securities by investors to the stock market. And that is why our stock market racked up a growth rate that was difficult to relate with the state of the national economy. But that still doesn't take away from the fact that the state of the stock market is a lead indicator of what will happen to our economy. So now, coming to my final presentation here, for every business COVID-19 impacted, that is whether you are based in Nigeria or anywhere around the globe, because this came from looking at businesses and the impact of COVID-19 all around the world. I call them the critical 9 business vulnerabilities as a result of COVID-19. So in therefore planning for your business in 2021, these are areas you need to pay attention to. And of course, the LCCI president, again, as I said, made reference to some of these in our opening remarks. Business model failure, meaning the way you used to make money before COVID-19 is going to be different post-COVID-19. Business disruption, lockdown, remote working, and the rest of it, market volatility, increased cost of doing business, liquidity shortfalls, raise default rate, customers, clients, ordinarily, that will pay you for services or products delivered, now find reasons and excuses why they shouldn't pay you. So, and that has become a reality that now will also impact the way you do business. Of course, increased counterparty risk and raised, fraud vulnerabilities. And of course, the big number, I call it the big elephant in the room, is cybersecurity risk. And why is that so? Because, as I said earlier, most businesses are now migrating to the digital platform. So now, just a little about the federal government budget for 2021. Yes, price assumption, oil benchmark at $40 per barrel, oil production at 1.86, and so on and so forth. But for me, as an analyst and as a Nigerian, looking at what is happening to fossil fuel globally, and how countries and even players within the oil sector are positioning for the next 10 years, there's a pointer that the demand for fossil fuel will begin to see a significant decline by the time we get toward the second half of this decade. And if that is the case, the question is, what becomes of a fossil fuel dependent Nigerian economy? And that's why I put this remark here, that I'm looking forward to the year that Nigeria will not have to base our budget on oil price, oil production, and export. But until we do that, we remain dependent on hydrocarbons and the vulnerabilities that are implied by that, as mentioned earlier by the president. So this is just like a summary, so I will skip this and then go on to my final take so that I can conclude. Now, what do we expect this year? I put a summary of the expectation of the global economy in 2021 by the World Bank. And World Bank says, although the global economy is emerging from the collapse triggered by the pandemic, the recovery is projected to be subdued. So global economy is expected to expand by about 4%. Of course, it will still remain lower than where the world was pre-pandemic, trend. But emerging markets and developing economies, Nigeria belongs in that group, are envisioned to firm up to 5% this year. But of course, as the IMF pointed out in their own just recently released, global economic outlook, the growth and recovery expected in 2021 is not only going to be diversified, it is also going to be differentiated, which means across regions it will be diversified, but within regions there will be differentiation, which means you will see, for example, Sub-Saharan Africa, but Nigeria also will stand out and not reflect the trend we expect for Sub-Saharan Africa, okay? And all of this is based on the fact that, yes, there are multiple vaccines and there's intensified vaccination. This is my summary of it, okay? And of course, economic activities adapting to subdued contact-intensive activity. This, of course, we know is not happening in Nigeria. Nigeria is taking a direction and a dimension that is not looking at the way things are happening all around the world. This has informed the executive order that the president just signed with respect to COVID-19 protocols. But IMF sees a global output expanding by 5.5% in 2021. Now, that is up from IMF's position about 3 months ago. That is on their outlook as at October 2020. So, but it is important to take note of this. A comment made by the chief economist of the IMF about 2-3 weeks ago. He said the ascent out of this calamity is likely to be long, uneven, and highly uncertain. How about Morgan Stanley? Morgan Stanley has a more aggressive outlook than the World Bank and IMF. So they see 6.4% growth of the global GDP in 2021. And of course, reference again is to emerging markets. And as economists reopen in the US and Europe, that is their own outlook. Now, coming back home, what is our own outlook at BA Consult? We see a Nigerian economy that will grow by about 2.34%. And for some of the reasons I mentioned earlier, and that is the fact that I pointed out that as at September 2020, the GDP of Nigeria at current basic price was already 75.4% of what we achieved in 2019, meaning that our economy was not behaving the way some other advanced economies or even some emerging economies are reacting to COVID-19. And then that is on the one side. There's also a snippet that I want to draw our attention to. Of course, I will leave that to my friend from KPMG. And that is the information released to the press yesterday, that from VAT and CIT, a total income in 2020, or let me say revenue, was 2.94 trillion naira. That means the corporate sector, the members of LCCI and other players in the organized private sector in Nigeria, that from us, the government realized revenue of 2.94 trillion naira. So I said, take a straight line projection, assuming that we all paid corporate income tax at 30%, okay, which of course is not really like that if you do proper tax planning. And then of course you look at VAT at 7.5%. If you consider that, that means there's a pointer to about 7.5 trillion naira income that these entities that paid tax in 2020 actually generated in 2020, which means really the implications, or let me say the impact of COVID-19 is not as greatly dampening or significantly dampening as we thought it would be for Nigeria. But of course, we still have an expectation that inflation rate will remain double digit, close to 15%, because if you expect growth, you must also be willing to live with inflationary pressures that will trigger. Now, what should business leaders take away from here? And this is like my final slide here. Now, the first thing is lifestyle change is irreversible, in which case it means in planning for 2021 and going forward, there is nothing like we are waiting for when we return to pre-COVID-19 era. As the president said earlier on, that may not likely happen sooner than 2023. And why do we say that? Before vaccines will go round enough to about 50 to 70% of the global population of about 7.7 billion people, cannot take less than the next 2 years. So if we return to doing business as we used to do in terms of contact intensive activities, that may not happen until the next 2 years. Then, of course, I've made reference to weak economic recovery. Most governments, of course, for that reason, are reluctant to lock down their economies, except in extremes like we see in UK. Of course, recovery will be tenuous and uncertain. The new normal, what I describe in fact as the next normal, is that most businesses are shifting online, that is on the digital platform. Purchases mostly are being done online, and of course, e-commerce is expanding. What does that mean for your business? That means in planning forward for your business, you must begin to look at and think and act on end-to-end value digitization. And that means, how do I originate transactions online? Can my customers and clients also get services, products delivered online? in which case, the only leg of physical delivery that will have to be done probably now will be consigned to logistics companies. And of course, knowledge sharing. This is the final part. And this is what the president made remarks about in our opening address. The first thing you must do, I call it navigational instrument, is to think global, but act local. And what I mean simply by that is competition is taking a different dimension globally. And so you may feel comfortable sitting in your corner here in Nigeria and think you are safe, but really, the next competitor to you might not even be in Nigeria, can come from anywhere around the world. So your thoughts therefore must be at that global stage, but acting locally to connect to the peculiarities of the environment where we are. Secondly, every member of staff of the organization must adopt strategy as part of their everyday job, which means this is not a time to keep strategy exclusive to either the executive or senior management. Everybody must get involved. Then number three is the one rule we talk about in marketing. But this time around, we are not talking about knocking on 10 doors, 100 doors, and whatever. It's about knocking on doors every day, which means the pursuit of business is going to take a different turn entirely. It is also a period where you must track and measure progress. If you were happy with measuring your performance quarterly or monthly, performance of your business must now be tracked on a daily basis. And that means if you, in any case, migrate your accounting software to the cloud version, you don't have any worry about tracking progress and performance. In fact, I would say by the minute. Then, of course, dealing with your staff. It means you have to redesign jobs to start with. In redesigning jobs, you also have to make deliverables measurable. That means every staff of your organization must have clearly defined key performance indicators. So that way you will now be able to measure staff contribution, not measuring tenure, but rather contribution of every staff to the company's performance. Finally, it's also a time you must constantly scan the environment and then give attention to what other people don't see. The era we are in, the next normal, requires you to see what others don't see. We may all be exposed to the same data, but interpret them differently. In which case, what you see might be different from what I see. So, but what I see will determine the decisions and choices I will make. And that is why you must begin to interrogate data and information on an ongoing basis. So my final word, 2021 looks more promising than 2020. And if that is something we agree around, it means then that we must prepare for those opportunities, because clearly the global economy is going to expand this year. And if that happens, Nigeria will also benefit in terms of the demand for hydrocarbons anyway. But at the same time, if Nigeria benefits, the question to you is, will the Nigerian economy grow faster than your own business? Which means you must benchmark the growth of your business against the global economy and also against the Nigerian economy. And probably now look at the sector where you belong as well, and ensure you benchmark the growth rate in that particular sector. The focus will be to outgrow, to outcompete, and to outmaneuver your competitors so that you can remain relevant and sustainable going forward. So thank you so very much, ladies and gentlemen. And my appreciation again to the President and Council members of LCCI. Thank you, sirs and ma'ams.
Thank you very, very much, Dr. Adedipe. Of course, we can't expect less. We've really been informed. We are grateful for that very insightful presentation. And I'm sure many of us would have taken one or two notes that will help us in our business planning for the year 2021. That's the purpose of this seminar, to help us be able to take informed decisions as it concerns our businesses, looking at the economic outlook for the year. Once again, thank you very much, sir. Now, before I move on, please, if you have questions on this presentation, you can use the Q&A chat box on your screen, below your screen, and just put your questions there. It will be easier for us to pick it from the Q&A than from the general chat box. So you use the Q&A to post your questions for us to see if you have any for this presentation. And before I continue, or before we move ahead, please permit me to recognize the presence on this platform of the Honorable Commissioner for Finance for Lagos State, Dr. Rabiu Olowo. Sir, it's a pleasure to have you here with us, and you are highly welcome, sir. So moving on from here, we'll go to the second presentation, and that will be done by Mr. Abimbola Olashore. He will be looking at the capital market outlook for 2021. Dr. Adigbe did mention the capital market. For us to know, Mr. Olashore is an engineering graduate of the University of Hull, United Kingdom, and a fellow of the Institute of Chartered Accountants of Nigeria. He also holds an MBA. He's a seasoned investment banker. Over the years, he has acquired in-depth knowledge and vast experience in the capital market, as well as financial advisory services in the public and private sectors. Mr. Olashore joined the Lead Bank Group in 1991 and became the managing director in 1997. As managing director of Lead Bank, he established the bank as one of Nigeria's top investment banks. The bank won repeatedly the Reuters SBA Award as the leading Nigerian issuing house for 3 consecutive years. He went on to join the board of EcoBank Nigeria PLC as executive director, where he helped set up their investment banking arm before returning to Lead Capital. He is currently on the board of Unico PFA Limited. Distinguished guests and our esteemed participants, join me in welcoming Mr. Abimbola Olashore to the floor. Sir, you're welcome. Please.
Thank you very much. First of all, is to thank the President and Council of the Chamber for inviting me to share my thoughts on the Nigerian capital market. I'm sharing my slide, I hope you all can see it. And I am to focus more on the market. And the first thing I'll probably say is that for the first time, there's enough evidence, which I'll show to you today, that our stock market is closely correlated with what is happening in the larger economy. And it also responds to what is the macroeconomic indices. So what that tells you that with the information I'll share with you today, it's easy for anybody now to forecast what will happen in 2021 based on your reading of what is happening in the marketplace. I think I've already forwarded my slide so you can share with everybody, because I'll just touch on a few points because I only have about 20 minutes. In terms of outlook, I will be just talking more about Nigeria in 2020 and now go to the key drivers and expectations for 2021 based on some economic variables. I'll also talk about the capital market opportunities and sectoral opportunities that are available in the marketplace. To start with, I think this point has been made that in 2020, the economy was dominated more by the fallout of the coronavirus. I won't really go, we all know the effect on that. I think more especially, there were some sectors that were hardest hit by the lockdown. So if you were in entertainment, if you were in aviation, if you were in sports, education, and retail, the lockdown obviously affected you. And I think for us, it's just for us to see how that relates to the business in general. Even though the lockdown was subsequently lifted, it certainly had a significant effect on the economy itself. We are currently in recession, even though we do expect that we'll come out of it in this particular quarter. And in terms of the numbers, we had a growth rate in the first quarter. Second quarter, the economy shrank by 6.1%. The last information we have is on the third quarter, shrank by 3.62%. Like I said, that is telling us that we are clearly now in recession. Now, how does it affect the economy in total? What I have here are 2 slides, so you can see the composition of the Nigerian GDP in the fourth quarter of 2019 as compared to the composition in the third quarter of 2022. The shades in red will tell you the sectors that contracted, and the ones in blue are the ones that grew. And what we saw was that based on the coronavirus and the lockdown and lifting of it, crop production grew. food and beverages grew, public admin grew, cement grew. And those that shrank were those that were in trade, petroleum, real estate, professional services, other services, education, livestock, broadcasting. So that gives an idea of how the composition of the economy changed over the past 1 year. Some sectors grew and some contracted. But more especially, what we need to see is the sectoral growth. You now ask yourself that which sectors actually grew and which ones contracted. Between fourth quarter of 2020 and fourth quarter of 2019 and third quarter of 2020, you can see significant changes. The ones that grew the fastest were information technology, water supply, public admin, finance, construction, health, and agri. Those sectors grew. But the one that had significant contraction, with the largest of 42%, were transportation, followed by accommodation and food in 22.6% contraction, then followed by education, real estate, mining, trade services, professional services. Now, what this is telling you the sectors that grew and those that contracted. And by the time we now go to the stock market, you'll be able to relate what has happened in the stock market to the larger economy. Now, looking at the economy in totality and looking at some of the indices, we have a rising inflation. Nigerian external results was fairly constant. You had McFarland PMI that I was talking about. December was a bit surprising because it shows a contraction, whereas in November there was an expansion. You have the exchange rate, obviously, you've seen the massive depreciation of the Naira. So just to summarize the economy in 2020, obviously the spread of COVID-19 and SARS constrained economic activities. Headline inflation for the rate of November 20 stood at 14.89%. And we've had a 15th consecutive monthly increase and the highest in 26 months, giving rise to a real interest rate gap between inflation and real interest rate of 6.5%. We have an expansion in the gap from 6.5% to 10 basis points in December. There are some other monetary policy directives that were given. The central bank directed money transfer companies to close Naira accounts and pay beneficiaries in dollars. Apparently, that is probably to put more dollars in the parallel market. Our foreign reserve remains stuck at around $35 billion for most of 2020. Now, that's just about the economy in total. I'll now move on to the market itself. And I'll start with the equities market. And what are the key drivers that we see? First of all, it responds to global conditions. If you have a lower growth environment, clearly the market will respond to that. If you have high inflation, high interest rate, the market will respond. For us in particular, there was a slowdown in the domestic economic fundamentals. We had a low interest rate regime. I'll spend more time to talk about that later. We had central bank intervention in the foreign exchange market as well. And the company results and corporate actions. That to me are the major things that shaped the market. And that resulted in the market. The first quarter, we had the market rising in the first quarter. The market fell in the second quarter. We had reversed the gain that we had in the first quarter. In the second quarter, there was significant fall. And the losses were later now reversed in the third and final quarter, and the market now settled at about 40,270 points at the end of the year, showing a significant growth. It is worth now to note that the market was basically driven by the corporate action and the results of highly capitalized stocks. And what do I mean by that? If you look at the market, you have 10 companies that account for over 80% of the market capitalization. So what that means is that if these companies should have better performance and they grow in turnover and they have good corporate action, most likely the market will rise. And in particular, these companies were also the ones that were positively affected by the effect of coronavirus. You know, I did make that point earlier on that which were the fastest growing sectors. I said, if you are in cement, if you are in telecoms, if you are in food and you're in financial services. So it's not by accident that 80% of the capitalization that is in the hand of these companies were positively affected by the coronavirus effect, and therefore the market also went up. And also, the turnaround in the market coincided with the increase in the oil prices. And I have this chart that is now telling you what has happened. When I tell you that the market is closely correlated with the larger environment, this is what I mean. Look at the first quarter by January, oil prices are $69, the market rose. Oil prices at the lowest point of $17 in March at the beginning of the lockdown, the market was at its lower point. When the oil prices recovered, the market started recovering. Oil prices to 38, you could now see the sustained recovery. So what that tells you that is a very strong correlation between what is happening in the market and our oil price, and in particular, also related to performance of companies in the marketplace. Now, this is a summary of a snapshot of the performance as of December. Like I said, the index closed at 40,270, opening at 26,842. That is a 50% change. Market cap also it closed at 21 trillion naira, up from 12.96 trillion naira. Average traded volumes also went up. Value also went up. Listed equities reduced by 3. And I think there's also a key thing here. You can see the PE ratio. And anybody that started in beginning of year 2020 with a PE ratio of 7.1, that tells you that his PE ratio actually is giving you an idea of how long it will take you to recover your investment in a particular market. And if our PE ratio is at about 7, it's giving about 7 in 7 years, you recover investment. That to me is a very fantastic return, even though by end of the year, it had gone up to about 14.5. But at the beginning of the year, at about 7, obviously, it showed that it's certainly a market that is attractive for investment. And that is why in the first quarter, the market went up. Another point I'll now talk about is the dividend yield in the marketplace. I picked out some institutions. I went to some banks. At the beginning of the year, the dividend yield of a bank like Zenith at the beginning was about 30.43%. What does that mean? A yield of about 34.3%. Even at that time when interest rate was still about 10, 11%, a dividend yield of 13.4% was extremely attractive. So therefore, a lot of people came into the marketplace. At the height of the peak of COVID, when the market crashed towards the end of March, the dividend yield of Zenith had gone up to 25%. 25% dividend yield. That is a no-brainer. That will tell you that everybody will move into and say, if I can get that kind of dividend, forget about capital appreciation. This is the time to invest in the market. What I'm saying about Zenith also output the guarantee trust. At the peak of COVID, guarantee trust had a yield of 15.47%, UBA for 17.3%, Access Bank 11%. What does that tell you? That at that price, dividend yield that you are getting is very attractive for everybody to come into the marketplace. So it is not by accident that all of a sudden you had the market that responded and obviously went up. These are some company performances. Like I said, if you look at stocks like those in Agric, Presco went up, revenue went up 24%. Okumu Oil in Agric, revenue went up 19%. Boa Cement, revenue went up 20%. UBA 6%. Dangote Cement 12%. Nestle 3.27%. So what that tells you that in particular, you've had significant improvement in the performance of companies that were positively affected by COVID. So what that tells you is that clearly the market responded, and we are not totally surprised with what we have seen. But much importantly is also to see the composition of those that traded in the market. Total transactions in 2020, these figures are as of November, increased by almost 30% from October. And I think what is good for us to see at this point is the fact that the market was dominated by domestic investors. And if you also see the percentage between retail and institutional, it was dominated by domestic institutional investors. What that tells you is that the kind of recovery that we've seen, since it is driven by domestic investors, most likely it will be sustained for some time to come. That is provided we maintain the same macroeconomic activities that is currently going on at this point in time. So for us, having a market that is dominated by domestic institutions now tells you that clearly the issue of boom and bust will have a sharp decline that we were seeing in the past when the foreigners exit the market. We don't expect to see this year. Now, comparing our market to other markets, this is comparing the Nigerian market with the rest of Africa. Obviously, it's also showing a risk reward. Zimbabwe market was the best performing with over 1,000% increase. I mean, you can understand it's coming from a very low base. Nigeria is second at 50%, and it goes all the way down. What I also did was to adjust for depreciation of the currency. So even adjusting for that, Nigeria was still the second best market at about 19.3%, adjusting for depreciation of the currency. Zimbabwe is still first, Rwanda third, Malawi fourth. I think the only one there is the Ivory Coast Abidjan, the BVRM, that adjust even though against their local currency went down by 8.7%, but against their currency that appreciated, it went up by 0.59%. So that's against the African market. We do tend to track the Nigerian market vis-a-vis other international markets. Compared to 2019, Nigeria did very well. We had one of the best performing markets against all these global markets, comparing it against the Russian market, Japanese market, India, Brazil, S&P, FTSE. So Nigerian market did very well. It really led the pack, and it's and the performance is also being sustained. Even coming into 2021, the market has gone up about 2%. That's as at the end of last week. And even though you have some other markets that have done well, but at least it shows that at least the market is sustaining the growth that we've seen so far. Now to go to the fixed income market, because I'll spend a bit of time on that. Again, is driven by what is happening in the global economy, movement in interest rates, obviously the GDP growth prospects, and more especially is also grossly influenced by the monetary policy of central bank. And I think this is quite key, because we saw what had happened that created a lot of liquidity in the marketplace. First of all, what did central bank do? They shut out domestic investors from investing in direct automobiles and made it open only for foreign investors. The imperial monetary policy rate was reduced from 13% to 11.5%. They're more especially, they brought about the loan to deposit ratio for banks. And as at December 2019, the rate had come out to about 65%. Therefore, they expected banks to give up about 65% of their loans of their deposits into loans. And if they don't, the money was sterilized with central bank. So what that gave rise to was that you now had serious liquidity in the marketplace with no outlet. And if you now go to what also now happened in terms of primary market for FBM bonds, for the first time, even though we're talking about government borrowing, fewer bonds were issued in 2020 than they did in 2019, even despite revenue shortfalls caused by missed budgetary targets. What that tells you that the instruments were just not available if government itself is issuing less bonds than they did in the past. So what that meant was that excess liquidity must find a place to go. So you now add that nexus of no outlet in fixed income, capital market showing very good returns. So it's just a no-brainer that everybody switched from fixed income to equities, and we've seen that. The following slide is just buttressing the same point. That you now add the yield in the secondary market declining to about 3.1% by December. Similarly, even primary market yields also came down. I'll move on. Even going to the FMDQ report, even if you look at total turnover in fixed income and currencies for 2020, also showed a reduction over 2019. So the key for me is just to now give you an idea that all of a sudden yields in fixed income started coming down, even both for federal government and also for corporate bonds. And obviously, once you have that kind of yields, and when people start looking for value, clearly the capital market, the equity market provided an alternative. I'll skip this. It's just giving you more information about what is going on in the market. Also, talking about the capital market is also useful to talk about regulatory activities to give you an idea of why we believe the market is also going to be much more efficient going forward. The demutualization of the stock exchange is gaining speed, and we do expect that to happen hopefully by the end of first quarter of this year. The stock exchange also launched the growth board, which is replacing the alternative securities market. They came up with rules on crowdfunding, and obviously they signing into law. And the CAMA provided the legal backing for development of derivatives market in Nigeria. So what that tells you is that obviously regulatory intervention is also going on, that is also improving the outlook of the market in itself. So what are the expectations for 2021? They will revolve around three things in our own view. One is the crude oil price, I've mentioned that. One is our 2021 budget, and obviously the happenings, obviously in the global economy. Obviously in the global economy, we know what has happened. A lot of economies went into lockdown, but again, that has been lifted. We do believe that with the recent development of the vaccine, we do expect there will be sustained growth from about the second, third quarter of this year. And certainly by the end of 2021, global economy will have started picking up. This is just a snapshot of most of our major trading partners. As you can see, a lot of them had a negative growth rate in about the second, third quarter. But again, hopefully by the end of the year, they'll come out. I think the only exception is the Chinese economy. Even though it had a negative growth rate in the second quarter, it had recovered by third quarter, and it sustained their growth into the fourth quarter, unlike all the other trading partners that were still having a negative growth. For us in sub-Saharan Africa, obviously we are highly dependent on oil and other commodities. We do expect a recovery in this year following the contraction of last year. Now, the key for us again to look at is implementation of our budget. Obviously for 2020, where we might have fully implemented the recurrent budget, obviously the capital budget must have been constrained because of revenue constraints. And I think it's also to make this point when people talk about government borrowing, which I probably have no problem with. If you go into recession, what that means is that you expect private sector turnover and economic activities to reduce, therefore their spending reduce. Once you have the private sector reducing its spending, you expect the public sector to come in and maintain the gap. Because if they don't do that, we will move from an area of recession into probably a depressed economy. So what we saw was government turning up next year to fill the gap. While we had the private sector spending going down, the public sector picked it up, and public sector spending was again financed. You could see the drawdown from IMF and also additional borrowing from the market. Now, you'll have expected that if the government was to borrow from the market, that should have an effect on the interest rate. I guess they didn't want to crowd out the private sector, and you can see their borrowing was from what they call unorthodox sources. They went back to borrowing from the central bank ways and means. And with that, we must keep on tracking, because once you do that, obviously it's giving a pointer to inflation. And once we have an inflationary environment, that will clearly give rise to sustained depreciation of the Naira. And I think the earlier speaker has shown you the prognosis for Naira going forward for the next couple of years. That kind of financing clearly cannot work. While you have achieved a lower interest rate environment, what you've now done is to stoke up inflation, and that itself will have an implication for the currency. For the year coming up, we can see even in spite of revenue challenges for 2021, we do expect that they'll be able to fund their recurrent, but hopefully they'll be fund their capital expenditure from additional borrowing. I've just tried to do a snapshot of the 2021 budget. It's probably to just make a few points. I'm quite pleased at least they are continuing their infrastructural investment. That is quite key. We must not slow down on investment in infrastructure. Obviously, it will be a deficit budget, and it will be financed certainly by borrowing. They spoke about privatization proceeds, and obviously they'll draw down on additional foreign loans. So what that tells you that if government do intend to borrow, and they will borrow from the domestic market, hopefully if it's also going to be financed by additional bills, and they've already started doing that. I think they issued their special bills in December, and we expect that. So if they do start issuing more bills, what that tells you is that we should expect interest rates to start rising. The other issue will be the stock price. The crude oil prices, this is just an average of the crude price for the last 10 years, but we do expect the oil price to remain at current levels of above $50 dollars. What I've done for expectations is to come up with 3 scenarios. What I have: the optimistic scenario, realistic, and the pessimistic scenario, depending on what is happening, depending on how far the economy opens up. Again, the effect on of COVID, also the issue of production capacity of the oil sector and our proceeds from oil. Also, the outcome if you have a low growth rate, if you have a higher growth rate, or if you have a growth of about 2.1% that is expected at this point in time. So based on that, what I've done is also have our own forecast. I've used a growth rate, therefore I've used a realistic growth rate of 2.1% growth rate for this year. Therefore, we will come out of recession, and if we have that, that shows that at least the economy will start improving. In terms of inflation, I've made the point that we do expect to have sustained double-digit inflation going forward. No doubt about that. Again, if we keep on financing through ways and means, clearly that will have an inflationary effect. So no matter what we do, we do expect to have double-digit inflation throughout the period. Some of the things that have fed inflation last year, some things have been done. We've seen imported inflation due to exchange rate devaluation. We've had increase in tariff. We've had the oil subsidy that has finally been removed and the impact that has turned up in oil price. So gradually, we do expect to have a high inflationary environment going forward. In terms of the exchange rate, we do also expect that Naira will continue to devalue. The official rate I do expect will probably move towards a parallel rate, and we do expect a convergence probably around the 430 to 450 level. So just to now round up, in terms of outlook, I think we spoke about interest rate. What do we see in terms of the capital market? I do expect that we cannot have the same 50% increase that we have last year, because the current rally, even though is based on the fact that the key drivers, about it, like I said, 80% of the market capitalization is the hand of companies that are doing very well. We do expect that interest rate will start rising, and once it starts rising, clearly people will diversify away from the market. Again, even in spite of the efficiencies that I see in the market, we expect further consolidation in the insurance space. We expect more delisting of some companies. But again, if you do want to invest in the market for the short term, we expect good dividend and bonus payments from the key companies that are there, and that will sustain the market for the time being. So from our own perspective, that is what I see for the capital market, that is still a market to invest in, especially the equities. At this point in time, the rally will be sustained, but what you should be watching out for is what happens to interest rate. And we do expect interest rate to start going up. We expect other investment in cryptocurrencies. The ability generation will be more challenging because of the negative real estate. But again, if you are an investment banking, it's the time now. We've already seen in the budget, they are looking at privatization proceeds. So there will be mandates for advisory work. Project financing also will turn up. And again, there are some sectors that were badly affected during the lockdown. And as the economy opens up, we do expect those sectors also to start improving. Therefore, areas in education, entertainment, obviously, if you are also in logistics and also in hotel and all these kind of businesses, we do expect all that to turn around this year, and we give you opportunity for further investment. So that, to me, my slides. I've tried to run through them, but they will be circulated to everybody to see. So on that point, I think I'll pause at this point in time. Thank you very much.
Thank you very much, sir, Mr. Abimbola Olasure, for that wonderful presentation. I'm very sure those of us who listened attentively would have gained 1 or 2 points that will help us in our decisions. Like I said, we have looked at the economic outlook for the year 2021. We've also listened to the outlook for the capital market for the year 2021. So you know what is remaining is now for us to look at how can we gather this information and then put them to use to ensure that we carry on with our business in a sustainable manner. We want to look at business sustainability. But before we do that, please, I can see your questions coming. Keep them coming. We will take the questions once we are done with the third presentation, and then we will direct them to the right persons that will give us, that will do justice to them. Now, we want to take the third presentation, which will be delivered by Mr. Mohammed Adama, who is a partner at KPMG. Now, Mr. Mohammed Adama, like I mentioned, is a partner in the audit service division of KPMG Professional Services, and has garnered 17 years of professional experience in providing audit and audit-related services to clients in a variety of industries and sectors, including the consumer and or industrial markets, government and non-governmental organizations, as well as telecommunications. His engagement has also included several special project audits and reviews, accounting services, due diligence reviews, and agreed upon procedures and services. With the transition to IFRS effectively in 2012, Mr. Mohammed has been involved in various IFRS conversion and implementation support exercises and audits, delivering the highest value expected with global tested and proven practices. He has served as partner and project lead in various statutory and financial audits and audit-related assignments, like I did mention, IFRS conversion, implementation support, and capacity building, as well as group reporting services. Distinguished guests and our esteemed participants, I have the pleasure of welcoming on stage Mr. Mohammed Adama. You are welcome, sir. You have the floor.
Okay, thank you very much, and for the kind words. I'd like to say, first of all, a very big thank you to Mrs. Toki Mabogunje and the leadership of LCCI for giving me this opportunity to share my views about business sustainability this morning. What I'll try to keep to the time, so I'll skip some of the slides that I have because Dr. Biodun Adedipe and Prince Abimbola Olashore, I think they've covered them already. What I've done is to try and do a look back into 2020 and then a summary of the outlook for 2021. But I'll skip that. I think you've heard a lot of that already. So I'll go straight into business sustainability strategies. This slide summarizes what I'll be speaking about. I'll be talking about 7 main themes. And these themes, they all revolve around having the right leadership as far as business sustainability is concerned. First, given our circumstance where we are, let me start by saying 2020, what a year. You know, it's the year of the pandemic, end SARS protests, and then recession, a second recession, within the last 6 years. So it's a year, I think, that we all would like to forget in a hurry. But the sad thing is, as far as the pandemic is concerned, we are not out of the woods yet. We are deep at I think we are in the second wave. And the initial fear of the pandemic during the first wave has gradually disappeared, and people are becoming more and more reckless. And so we don't know where this is going to take us, but we hope that we end 2021 without pandemic. So now, talking about these 7 themes, I did mention that it all comes down to having the right leadership as far as business sustainability is concerned, the leadership that can nicely bring all the resources together, human and material, towards working with the objectives of achieving the company's mission. So I start with the first one, which is safeguarding your people and your customers. With the second wave that we are into, it is critical that you keep safety first. You know, safety of your people and of your customers and of your critical stakeholders. You need to keep and maintain the physical well-being of your employees. With the way we work at the moment, it is not clear if we will ever go back to what we used to do. Life may never return to normal again. And with that in mind, it's absolutely important that you secure the safety of your employees. First and foremost, make sure that you provide an environment that will enable them to achieve a certain level of work-life balance, you know, in the workplace. This is absolutely vital if, as far as the execution of your plans for FY 2021 and beyond is concerned. You can have a beautiful plan on paper, and at the end of the day, the difference between success and failure really lies in how you execute those plans. And what makes that difference is the people that you have. So related to that is retention. You have to make sure you retain your very best people. And trust me, we're going to run into a shortage of talents in the medium to long term in Nigeria. And why do I say that? You know, migration is dealing us a big blow. And I don't think many people realize, you know, the risk that we face from that. If you look at Nigeria today, especially the middle-aged, younger people, the youth, almost everybody wants to get out of the country because of a lack of confidence in our country. And in doing that, you know, they are going to Europe, the UK, Canada, and the likes. And who are the people living? They are the educated, the skilled, and the young. Those are the people, you know, that are living based on the criteria that those countries set. It's people who are very well educated. In fact, if you have a master's degree, you are better off. Your chances are much, much higher than someone with a first degree. So they are taking the very educated, the skilled, and the young. And so they're leaving us with the not so educated, the unskilled, or the too old or too young to work. And that is not a situation to face. In our own space, for instance, this is a major problem we're struggling to fix. And I believe if you're in the service industry, within the service space, where services or where skills are easily transferable, you may be feeling the heat as well. Those in the service industry are feeling the heat. And so it's important that as you plan, also have a plan to retain your very best talents, your best people. I've spoken about the work from home environment, and we may never return to working normally from the office from now on. And if that is the case, then you need to have a plan, right, that your people can work around your normal processes to reach decisions very quickly. You need to have a system in place where your teams, your senior, your executive management can take decisions quickly. This is important whether you're working from home or whether we don't expect it to happen, we have a second lockdown. It's absolutely vital that you have those plans in place. Then moving on is supply chain management. Secure your supply chain. This is very important. We've seen the disruption, you know, that a lockdown or a global crisis can cause. We've seen that during the lockdown and how supply chains all over the world were disrupted. So you need to have alternative plans with respect to raw material supplies. Try to backward integrate if you can. Take advantage, have plans to take advantage of the Africa Continental Free Trade Agreement, which is now in place. Yes, it's early days, but have a plan for that. The risk of depending on offshore suppliers all the time, first is if you have this type of lockdown or restrictions again, you run into big problems. That's one. And two, you're also not very sure of government policies. I think a few months back, the government placed some restrictions on importation of maize. And we saw what happened then. For some manufacturers that are in the animal feed, for instance, subsector, for instance, it became a problem because we don't have enough locally, and then you can't bring it in because you don't have access to FX. There was a restriction on FX allocation to them. And so it became a problem. So you need to have plans, whether you're working with local farmers, if you're into agribusiness or any of the activities within the agro-allied sector, you can have arrangements with local suppliers or farmers on an off-taker arrangement, and you strengthen that arrangement so you get them loyal to you. Not just an arrangement, but an arrangement of loyalty to secure your supply chain. Also, have a look at your entire value chain and perform an assessment of the risk factors that may escalate your costs very quickly. And you then need to develop proactively, plans and arrangements to address them. Now, with technology in place, you need to be able to explore opportunities to balance internal supply chain with outsourced supply chains. You don't have to do everything yourself. It is some people's business supply chain, and you can leverage on them to bring down costs. And under the current circumstance that we have, you can also enter into arrangements with suppliers, try to lock down inventory at a particular price, try to lock down prices of your critical inputs, at least so you have 3 to 6 months, of inputs secured. In Europe and elsewhere, a number of the companies haven't resumed fully yet. They are still under lockdown. And this is an opportunity to negotiate and lock down prices, at least for the next 3 to 6 months. And I think this is where you have that opportunity because they will be open to it at this time, given what is happening, globally. Moving on to the third one is have counter-cyclical financial management system in place. At this time, I cannot emphasize the importance of liquidity. As the saying goes, cash is king. Actively monitor your cash flows. You have to do that at this time, and you have to plan. I think it was when Dr. Adedipe spoke earlier, he did mention that, in fact, planning 6 months now is too long. You can't even say you want to plan for 3 months. Quarterly planning is too long under the current circumstance. Your planning have to be short-term. Your cash flow forecast, you have to do it weekly if you can. If you can't, at least monthly at the minimum. You can't do quarterly anymore. Do weekly if you can. If you can't do weekly, do monthly. And then you review, the outcomes of your cash flow projections and realign based on, your existing circumstances. You also have to renegotiate terms with counterparties, your vendors, your suppliers, and you do that such that you are in a net positive situation. What do I mean by that? If you're giving your customers a payment term of, say, 30 days or 60 days, then you have to make sure that your payment terms with your vendors is more than that. You have to try and secure 70 days or 90 days with your vendors if you're giving 60 days to your own customers, so that you have some room, to maneuver as far as liquidity is concerned. So you are able to collect cash from operations on time before paying your vendors. It's a tricky one because as you do that, some vendors who are smart may also want to put a premium, with respect to maybe building an interest element for cost of financing you. So it's a tricky one, but it can be done. And it's something you need to explore. You also need to manage your credit risk. There's a heightened credit risk out there, and you have to plan for that. This affects not just your cash flows, but also your financial statement as well. Because once with the IFRS 9 that is applicable to financial reporting now, your credit risk and your impairment losses could skyrocket quickly if your customers default, and default rates can escalate very quickly under the current circumstances that we have. So you really need to put that into your plan and build slats into your forecasts as well. As much as possible, for new customers, try and see if you can get bank guarantees in one form or the other. Focus on bringing in advance payments from your customers or deposits from them up front, to help you manage your own liquidity. The fourth theme I would like to talk about is your funding strategy and FX management. Having long-term planning, funding plan is absolutely vital. You need to simulate various scenarios, and for each scenario, develop a contingency funding arrangement. If you have them in place and you don't have those scenarios well and good enough, but it's better to be prepared for different scenarios so that you are not taken unawares. FX, I think the Prince Abimbola spoke earlier about where we are on FX, and Dr. Adedipe as well. The FX crisis is still here with us, and it's not expected to abate very soon. And so you need to plan around that, especially if your operations are heavily dependent on FX. If you are heavily dependent on imports of materials for your operations, then this has to be a daily activity, for some strategic executive management level. In fact, one of my company one of my CFOs, told me that one thing that keeps him awake now daily is FX. That is what he loses sleep over. And that is understandable given where we are. It's possible that there may still be another FX adjustment. That is very possible before the end of FY 2021, but having a plan in place will be helpful. And good enough, there is the FMDQ has forward contracts that you can utilize, to hedge against your currency exposures. And there are various ways of doing that, both for liquidity purposes and in terms of accounting and reporting purposes as well. Try to diversify your funding sources. At the moment, rates are low. So if you're sitting with a facility or a loan that is still running at double digits, for instance, you may want to consider taking another loan at a single digit and repaying the older ones. And some companies are already doing this. I know some businesses that have issued bonds recently, and the bonds they issue were at single digits, 6-7% for 5 years. That's really wonderful, given that you have inflation running at 15-16%. They were able to secure the issue bonds at 6-7% for 5 years, and they have used the proceeds to repay loans that they have at 12-13%. And by doing that, you immediately bring down your finance costs, and that flows directly into your bottom line. And I think you need to consider this as well. Of course, there are factors that may be outside of your control. The government has various intervention funds through the CBN. If your sector qualifies, the health sector, agro-allied businesses, manufacturing, there are various funds out there through the CBN that I can take advantage of. And those are single-digit interest. If we recall, I think it was in March or April last year that the CBN reduced the interest rates on those interventions from 9% to 5%, and also extended the moratorium on repayment for 1 year on all those interventions. Yes, they've said, that is for a period of 1 year, ending March 2021, But we are hoping that the CBN, with the second wave of the lockdown, that they'll see reasons, to extend that scheme, both the moratorium and the reduction in interest rates for 5%, because there's, we're not out of the woods yet. Moving on to cost management. Where we are today, everybody is focusing on cost management. You have to find ways, creative means of bringing down your costs. You need to conserve cash. And one of the ways you can conserve cash and maintain a healthy liquidity is to bring down your costs. And there are various ways of doing that. You need to be able to control all controllable costs. And I say that again, all controllable costs, be it labor, rent, especially in areas that are non-revenue generating within your business. You need to try and bring down the costs. You don't need all your executives to travel on business class at this time, for instance. I mean, you don't need that at this time. And I know a company that has done this. When the lockdown started, I think it was in June, they took a decision. It's only the CEO that will fly business class. And they are still there. They're conducting businesses normally. Nothing has happened. Suddenly, they realized that it's possible. I mean, before then, they thought that wasn't something that would be acceptable to their people. But it's about how you communicate and then how you manage the process and the people you have, making sure you get them to see the bigger picture. The company has to exist first. Whatever benefits, be it minimal, be it small or luxury that is there, the company needs to survive first, and then the benefits can flow to everybody else. And you need people to see it from that light, and then try to see where you can bring down costs, especially for non-revenue generating areas of your business. You also have to look at even the very structure of your business, the design, the business model, your business structure, the way you are structured, is that optimal? Question your existing structure. Question how you currently do things. And there might be opportunities there for you, to explore. You have some companies, for instance, that are in a group and they have several subsidiaries. Do you necessarily need all the subsidiaries? Can some subsidiaries become divisions, right? In which case you already have, an opportunity to eliminate some costs of regulatory compliance, filing tax returns, filing returns monthly and annually, having AGM, board meetings, and all of that. Just look at your structure, question what you have, and see how you can realign the businesses that are similar or where you have synergies that you can leverage to reduce your operating costs. And it's important that you try to focus and differentiate between productive and non-productive costs. This is critical. There are some costs that you can do without for now, and there are costs that are only a nice to have. Determine those ones and work with your management to eliminate them. Invest in business growth and productivity, and you have to do that very carefully, determining whether a new investment or a new expenditure relates to production, is bringing in cash, or is generating demand, or is creating an additional customer. If you don't have that, then you have to examine whether you need to incur that cost or not. It's either is focusing on growth, you are generating a new product into the business that is viable, you are trying to build a new customer base, or you're trying to develop, something that other existing businesses can leverage on to grow. And of course, you need to demand accountability from your people. strategic risk management. At this time is very important. I think somebody said that recession is not a good thing, that nobody likes recession, but that you don't waste a recession, that recession provides an opportunity to do things differently, to look at how you're running your operations, how you're running your business, and then change the way you do things, change the status quo and do things differently. And in doing that, look at your current business model. What are the risks in there? Reassess your enterprise-wide risk at the entity level. What are the major risks that your business is facing? It could be product price risk. It could be supplier risk, right? It could be regulatory risk. It could be FX risk. So do a risk assessment. If you've done so already, most companies already have. Go and reassess it and prioritize. What are the key ones? What are the most important ones at this time? Is it FX risk, input risk, supply chain risk, regulatory risk? You need to map them out and prioritize them and focus on the top risk. Those ones, you have to have a means of constantly monitoring them and developing alternatives if those risks should materialize. In the example I gave earlier with respect to maize, you need to look at your inputs. Is there anyone there that potentially the government can, come up with a restriction or a complete ban tomorrow? And if that happens in your business, what would you do? If you have a major product, for instance, you produce flour or some other product and you import wheat, for instance, if the government wakes up tomorrow and decides to ban wheat, for instance, that we don't produce in Nigeria, we don't produce anything near enough in terms of our requirements. So what happens? And there's no guarantee. Nothing is guaranteed as far as the government is concerned. So people make decisions, based on some short-term considerations. So you need to look at the various risks, determine planned scenarios, and then have plans in place. If this happens, what do I do? You need to have that in place. Understand your competition. Understand the changing competitive landscape and develop plans to stay ahead of competition. And it's important to reiterate here that, the competition of tomorrow, your tomorrow's competitor may not be obvious today. In the last decade, we've seen how people start businesses. They start from an area that is completely unrelated to your business. And you say, oh yeah, that's another line of business, so it doesn't concern me. And you ignore. And then over time, using technology, people begin to encroach into your space. And before you know it, you are in direct competition with them. And by then, it may be too late. So recognize that fact that your competitor tomorrow may not be obvious today. And it takes, careful thinking to recognize that fact and plan ahead. Then digital security. Like I said before, life may never return to normal. Work from home has become the norm for some organizations, even here in Nigeria, especially within the service industry. Work from home has come to stay, for some people. And with that, you have a heightened risk of cyber fraud. Cyber security risk has increased. Cyber fraud has increased, and you have to plan for that. You need to intensify your efforts at creating awareness amongst your employees, your customers, and providing them tips on safe use of your digital assets and channels, how to remain safe digitally. Cyber criminals and cyber fraudsters are on the prowl, and they keep developing creative means, of doing their own business. So you have to remain ahead of their game. to survive. That's a critical area. So if you, whatever plans that you have, you need to make sure you incorporate cybersecurity. It's absolutely vital. And why this is important is because of your business need. You need to leverage on technology. There's a growing e-commerce out there that you need to leverage to grow your business. And in doing that, however, you expose yourself, to cyber risk. So you need to plan. But you cannot, because of the risk, sit back. Your business will be taken over. You'll be taken out by competition before you know it. So that is, not adopting technology is not the solution. It's rather planning around it. Technology provides tremendous opportunity for businesses to grow. And with that opportunity comes risk that you need to then develop strategies to monitor. And of course, strategic agility. You need to remain swift. You need to be able to respond to issues, crises in a very quick manner, in a very swift manner. To do that, you need internal synergies. You have to encourage collaboration and cooperation amongst various departments within your businesses, from production to sales and marketing to finance. People have to work cooperatively. People have to collaborate seamlessly. And that is what will give you the agility that you require at these times. Leveraging on technology to digitize and automate your operations. I mentioned a while ago about the opportunity presented by technology. So we've seen during the lockdown how businesses that are able to service their customers remotely, how they were able to do well. So depending on the nature of your business, see how you can automate your process end to end. Make it possible for your customers to be able to place their orders, make payments without having to go to the bank or come to your office. They have to place their orders without having to come to your office, make their payments, and then you can deliver products or services to them without having to visit their premises as well. And that is where businesses are moving to. And if you want to remain, and be able to in business and be able to compete effectively, you have to explore this, remain competitive. Even if you have a factory, people who have factories are, leveraging automation. There are a number of factories that I've visited. You enter the manufacturing floor, the factory floor, and you only see 4 or 5 human beings, where you used to have 500 people before. You have 4, 5. They're only making sure that the equipment are working optimally as they should. Just periodic checks here and there. They do nothing. The entire facility is automated. And that is where people are going. And I think it's important to have that in mind, if you need to continue to. That will not only bring down your costs, but also ensure you are able to service your customers, even if you have this type of disruption, the likes of the pandemic and the lockdown. Even if you have that, you'll still be able to serve your customers, because you need fewer people to run the operations as a result of the automation. And in terms of delivery to your customers, you have logistics companies out there, that are available and can provide that service. You can leverage them. You can outsource some of the processes. And of course, in doing that, don't forget the cybersecurity risks and the fraud risks, and develop plans to mitigate those risks. From your employees, they need to focus on servicing the customers. No matter the situation, pandemic or not, lockdown or not, the customer is still, the most important person as far as your business is concerned. You take the customers away, there will be no business. So your employees must understand this and focus on servicing the customers and empower them to be able to do so. Empower them to be able to work remotely. Look at your infrastructure. See things that you can move to the cloud. See things that See how you can empower them from home to do what they have to do to keep your customers happy. You know, this is also very, very important as you plan. Just additional thoughts on this slide, you know, is kind of summary of what I've said in terms of what businesses or corporates should be doing. You know, have headrooms, have slacks, you know, in your plans, in your forecast, building slacks, building flexibility. You need to be flexible under this, under the pandemic and under work from home environments. Try to hedge your FX risk, be it natural hedge or using financial instruments to hedge the risk. Strategic agility, you have to respond very quick, be swift. You have to be very, very swift in terms of responding to issues, responding to customers' demands. And customers are demanding more for every naira they spend. People want the best for every naira. And you have to be able to satisfy, you know, that demand to keep your customers. Otherwise, competition is out there waiting for you to lose one. If you lose one, trust me, you lose a second. Cyclical planning, try to see swings. If there are swings in your business, you have to plan into that and manage your stakeholders via communication. Communicating with your stakeholders about what you're doing, the plans, and being transparent about that communication is absolutely important. Regulatory compliance is another area I spoke about. As we know, the government is looking for money to fund the budget. You know, you're going to be having tax inspections, tax audits. Many of you are used to that already. That is not going to stop soon. Have a plan for that. Make sure you are organized. You know, organize yourself properly. Businesses operate now. A number of even government agencies are making it possible, you know, for people they are regulating to be able to engage them remotely. The FIRS, for instance, you know, has made it possible for you to be able to file your tax returns online. Organize yourself in-house. You can't be lagging behind your regulators in terms of adoption of digitization. If they make it possible that way, then you have to make it possible as well for your tax manager to be able to file your tax returns from his room. He doesn't have to go to their office. And I think that is a no-brainer given where we are today. And of course, scaling up your operations. So these are ideas that I think I have that I've been able to share with you this morning. And I'll be happy to take any questions that you may have. Once again, I would like to say a very big thank you to the leadership of LCCI for this opportunity. Thank you for listening.
Thank you very much, sir, Mr. Mohamed Adama. Thanks for helping us to run the full circle. Like I mentioned when we started, we need information, and all this information is to help us run our businesses sustainably. And the strategies you've given, I'm sure when we, those who have listened carefully, put these strategies into play, they definitely will be able to stay afloat in these turbulent waters that has been caused by the pandemic. Once again, we are very grateful and thank you so much. I think we quickly need to move now because we have questions that are coming in, and it would be nice for us to take few of them. If Dr. Adedipe is still with us, it will help us. If not, I will push the questions to the other resource persons that we have. We have Abdurrahman Yunusa. He wants to know what's the view of our resource persons on Bitcoin as well as virtual money in the new normal that we're talking about. As well as there's Ilesami Imisi, who wants to know how the new impact will affect the real estate market. If Dr. Adedipe is around, he can help us with that. Or let me just make it three. There is also a question from Mrs. Sarah Susan, who noted your comment concerning the gap between export and import, and she wants to know the practical steps that manufacturers can take in bridging this gap. So, Dr. Adedipe, you can help us with that.
All right, thank you so very much. Now, with respect to Bitcoins and virtual money, as in fact, the three of us said in our presentations, COVID-19 has brought us into a digital evolution that is completely different from what we envisaged before the end of 2019. And how do I mean here? And I will give a few statistics relating to Bitcoins and virtual currency. Now, there is an interplay between cryptocurrency, the US dollar as a currency for international trade, and also for store of value in terms of assets of nations. Now, equally, the third item there is the gold. So usually for those who look at Bitcoin as an investment asset or a store of value, which is what Bitcoin is popular for at the present moment. So the reality is that the projections are, if you invest in a Bitcoin, the question is, what value will it likely become in another few years' time? We've seen all manner of projections. Some say that, look, in another 5 to 7 years, the likelihood is that Bitcoin will be about $1 million value per unit. And why is that so? They look at the way transactions are going on around there today, about, like 1 million holders every month. And you have currently about 100 million holders of Bitcoins all around the world. And of course, in addition to that, you now see that the value of Bitcoins on a daily basis is about $1 billion US. So that by the time we put all of this together and project, so they say what you see today, going to some might be like, oh, this is really, really aggressive, might likely be in multiples of that in another 5 to 7 years. But the question again is this: Bitcoins as a means of payment is worrisome to monetary regulatory authorities all around the world. And that is why it is very rare, except maybe 1 or 2 countries, where the regulatory authorities have approved, that people should actually trade in Bitcoins. And the reason is also very simple and clear. And that's the point I will leave here with respect to that question. Now, for Bitcoin's processing in terms of transactions, it cannot process more than 3,000 transactions every 10 minutes. And that is some measure of inefficiency as a means of payment. Then secondly, there also, for every transaction you pay for with Bitcoins, you are also going to pay commission of 1.49%. And that's a very high transaction cost. So which is why, if you look at it, therefore, as either a means of payment or a store of value or an investment asset, more of those that deal in Bitcoins look at it more as investment assets. So that I will leave it there. So but the reality is that the pandemic has actually thrust forward the relevance and importance of Bitcoins in the era we are. In fact, if you look at PayPal recently put out information that you can use your PayPal wallet either to buy or to sell Bitcoins, or in fact store Bitcoins value in that your wallet. So it just shows clearly that as time goes on, Bitcoins become more important, in those 3 respects. The second question with respect to real estate. Yes, I had mentioned that real estate is one of the 6 major contributors to our GDP in the last 10 years. But there's also something that has been established in terms of economic relationships. And this dates back to the Great Depression of 1929, 1930. And that is the relationship between the real estate sector and gross domestic product, GDP. It's been established that during either a financial crisis or banking crisis, whenever the crisis hits real estate first, there's always a dampening of GDP by ratio 1 to 2, which means when a crisis happens, that is when you realize how important real estate is, apart from the fact that usually also, whatever happens in that sector is taken as a 6 months lead indicator of what will happen to the domestic economy. So as it were, therefore, that's why we keep encouraging government that the government needs to particularly give attention to the real estate sector, because there you create jobs, and jobs that you create across the entire spectrum. Low income people, middle income, of course, who are the major investors anyway in real estate. So that unless government intervenes there, we will see a real estate sector that may not respond and drive growth of the economy the way we normally will expect. So that depends a lot on government's policy and actions. Now, the third one, which was raised by Mrs. Choso, is a very interesting one, because relating to that conversation, I've been privileged to be involved since 1987. And that is talking about the interplay between imports and export and our commercial policy. And I've seen quite a lot within that space over this number of years that have made me to come to a point that when it comes to relating with the rest of the world, it is a matter of your choice as a nation, whether you really want to protect your economy against the rest of the world or not. The argument then in 1987 was that Nigeria should open her borders and that we should allow anything to come into Nigeria, but only discourage importation by putting a very high import duty regime. In fact, the World Bank at that meeting, which I attended, recommended 500% import duty on any good we want to discourage this importation. And my response then at that meeting was that as a Nigerian, and knowing the way we also interpret policies and respond to them, that the typical Nigerian will not move away from an item to purchase simply because it's expensive. In fact, if he has the means to purchase it, he wants to buy to prove a point that he can afford it. And that brings us to this nexus. Now, I differ a little about the observation there that it has always been a case where exports have always been less than, exports have always been less than imports. It's not always so. Now, what we always do is we separate between exports in the aggregate and non-oil exports. So the problem of our economy is that we have been largely import dependent, both with respect to oil and non-oil goods and services, and that's where the problem is. So the narrative now is, how do we put a policy in place that will encourage domestic manufacturing that will substitute for imports to start with? And then secondly, to deliberately encourage export of non-oil goods. And that is where the real issue lies, to encourage the export of non-oil goods. So in fact, if you look around the world, in particular, use an example of China. What China set as a policy was to produce and supply what its population consumes. And this is something we've been talking about forever. I was a part of a conversation in Paris in 1990 March, talking about how Nigeria and other African countries can produce here and supply the rest of the world. It's all about exporting of non-oil goods and services. So the government must be serious about it, introduce policies that will not only support that, but actively even fund that process. And I think that is where the issue lies. There is, yes, within the range of what you can do as an investor, no doubt, you can work within the range of what is available because the policy remains a constraint anyway. But it's only when we have a crisis of the nature we have on hand, either you have economic recession as we have, or you have a currency crisis. It is when you have a combination of those two, it becomes more important for you to look at exporting more to the rest of the world. Now, let me stop there because there are quite a lot of things that we can still talk about in that respect. Thank you very much.
Thank you very much for those answers, Dr. Biodun Adedipe. Please, before we continue, we will be uploading a short survey for participants and our distinguished guests to help us quickly fill. It shouldn't take more than 1 or 2 minutes. Once it comes on your screen, kindly fill them, and then you'll be done with them in 1 or 2 minutes. Thank you. So the other question, I'll be directing this to Mr. Abimbola Olashore. Somebody raised the issue of insecurity. Where do we put insecurity in all this? I think is Marcel Okeke. We're talking about the capital market outlook. How does insecurity, how does it affect this outlook or the projections that has already been discussed? If Prince Abimbola is still there with us.
Okay. Thank you very much. The way I look at insecurity, I always say things has to do with what I call risk-reward issue. And what insecurity does is to increase your cost of doing business. That will be factored in anybody that is taking a decision. The truth of the matter is, at the end of the day, it's all about evaluating the risk, and insecurity is one of them, and not saying that the returns I'm going to get, it doesn't justify the investment I'm making in that environment. You saw my chart when I showed you the African markets. The best growing market is Zimbabwe. That showed over 1,000% increase. But how many people will go and invest in Zimbabwe? The outlook might be positive. People might say, yes, the market might go up, but the reality of it, I would not say, even at 1,000%, I will not go and invest in. Security does play a major role, but clearly it's not down to the risk appetite of each individual. But for us in Nigeria, insecurity has clearly increased the cost of doing business, and that has also fed into everybody that is doing business. Before I set up business in this environment, and before I make profit, I ask myself, what is the cost? And that is one major cost of it. So I think that's my comment along those lines. Thank you.
Thank you very much, sir, for that. This question is for Mr. Mohammed Adama. There's a question on the Finance Act that has just been released, and that has to do with the reduction of the import levy for the for vehicles. This person wants to know how will that impact on the automobile industry in Nigeria.
Okay. So, it's a very delicate one. For one, if you look at most of the logistics companies in Nigeria, they import vehicles or trucks, be it buses or whatever, they import them, from overseas. And I think what the government is trying to do is to cushion the impact of the increase in PMS. As you know, the price of PMS has been increased, subsidy removed, subsidy not removed, not here and there. But what we know is the price has gone up. And that has a cost implication for logistics, cost of moving goods from one part of the country to another. We don't have, we don't yet have a functional rail system. And so movement of goods is really by road. And with the increase in PMS, there's an increase in price. So government is, I think the thinking is, why don't you reduce the cost of transportation by taking off parts of the import costs, which is the VAT. That's what they've done. But they didn't stop there. They also reduced on even cars as well. It's good in a way for logistics businesses, because you can take advantage of that. And for those who are into logistics business, I think you can take advantage of that, bring in your trucks or your vehicles that you use for your business, because that policy may not be there after 2023. Trust me, another government will come and revert back to 40% VAT. So if you're into logistics business, this may be a good time. You may want to take advantage of it now. Having said that, for the auto space, the auto industry space, however, it's not very good for them, because it brings them into competition again with overseas suppliers. But this is the thing. if you look at most trucks that are coming in, the government doesn't give FX to car importers. Many of them don't have access to FX. So I expect that the constraints on FX availability will have a moderating impact on that policy as far as the auto industry is concerned. I think Dr. Adedipe spoke about it very well, and I like the angle he approached the FX issue. It's really about our ability to produce locally, and we are limited by all means. So I think that FX impact can moderate the effect of that policy on the auto industry. But again, for logistics businesses, I think it's good if you have the money on, or you need to take funding or loans. Now that you have low rates, you can actually take advantage of that, and bring in your trucks or whatever you want to do, because that policy will not be there forever. It could change very rapidly into 2023.
Thank you very much, sir, for that answer. I'm sure the person that raised that question has gotten the point. We have questions still increasing and coming in, and we are one for time. But before we stop this session, I quickly want to ask Dr. Adedipe to help us with this question from Dr. Olajide Basharun. He's talking from the agricultural space. His concern is with the increasing cost of feed for those in poultry, and he wants to know what macroeconomic policies that can be recommended to the federal government to mitigate against this. We know what the food component of our inflation is doing to headline inflation. So this is a question from Dr. Olajide Basharun for Dr. Adedipe.
All right, thank you so very much for that. The question simply is this: if the price of maize and soybeans have gone up, what could be responsible for that? That, in fact, to me, is a reflection of where the maize and soybeans are coming from. So if we have challenges, which in fact relate to security that Prince commented on earlier on, and I raised this 5 years ago. That was when we were having this challenge of recession on the one hand, and then the issue in official quarters that we brand as the farmers' herdsmen clashes. And I sounded a note of warning then that whatever happens that makes a farmer to run away from his farm means eventually we lose what would have been his harvest for that season. And when that happens repeatedly, and I sounded that warning also January 2017, that means you will now have to import what hitherto you were producing locally and making available to the consumers. So if now we found ourselves in a situation where there is shortage in terms of local production of maize and soybeans, that gap naturally will have to be bridged with imported maize and soybeans. And when that happens also, naturally the interplay between supply and demand will make the price to go up. So the critical thing for us as a nation is to come to terms with the reality that if the farmers that cultivate maize and soybeans do not have the security environment that will make them continue going to the farm to produce, then what we see today as the food inflation will remain a problem with us. I sounded that warning January 2017. So for me, the reality Nigeria is facing today on food inflation is not a mirage. Neither is it a surprise to me, because
Oh, hello. I think we lost connection from Dr. Adedipe's side. Well, I think, okay. Are you back with us, sir?
I'm back. Sorry, it's a connectivity issue. I will just conclude it this way, that the price of maize and soybeans that are large component of feed in poultry business now becomes a constraint to you as a poultry farmer. So, and going back to what Mr. Adama said earlier on, the real issue will be how do you respond strategically to this particular constraint that you have no power over. So the only recommendation we can make to government is to look more in the direction of providing security for farmers that cultivate maize and also soybeans. That's the only way to go, medium, long term. It will not happen immediately, but for you as a business person, the question should be, what are those elements in your strategy choices that we need to deal with in order to survive this period when these items of input are expensive? So thank you very much.
Thank you very much, sir, for that answer. I'm sure if we have to continue, we'll go on and on and on and on. And we have many more questions that I'm not sure we'll be able to take. Sincere apologies to all those who have thrown in those questions. We know with the constraint we have here, just as the constraint of the farmer has to do with high cost of feed for poultry, we have a constraint of time too here, and we need to go so that we can also attend to some other issues. So based on this and on that last answer, we want to sincerely thank every of our distinguished guests on behalf of the president of the Lagos Chamber of Commerce and Industry. We want to appreciate our resource persons, very wonderful resource persons, Dr. Biodun Adedipe, Prince Abimbola Olashure, as well as Mr. Mohammed Adama. You have really kept us glued to our screens, and I'm sure business owners have learned one or two things that will help them steer their ship in this turbulent wave that we found ourselves as business people. So we want to thank all our participants too, wonderful participants right from the beginning till now. They've all stayed glued and they've been part of this discussion. And we hope that we'll continue to apply all this knowledge that has been gained from this discussion so far. So on this note, I want to say thank you to every one of us, and we hope to see you the next time LCCI comes calling for another wonderful opportunity to learn. So I will say bye to everyone. Bye-bye.
Thank you, Matthew. Bye-bye.
Bye-bye, man.
Having me. Bye-bye.
Bye-bye, sir. Thanks for obliging us. Mr. Adama.
Thank you.
Bye-bye. Thank you so much.
Yeah. Yeah.